Right now, as we watch the markets unfold on this Tuesday, November 25, 2025, SoFi Technologies Inc. is trading at exactly $27.48 USD, showing a slight intraday push of roughly 0.24% in the green. If you are watching the charts this morning, you are seeing a stock that is fighting to break out of a consolidation zone, hovering just under that psychological resistance level of $28. The movement today might seem subtle on the surface, a mere fraction of a percentage point, but the reality beneath this price action tells a story of immense friction between the bears who believe the valuation has stretched too far and the bulls who see a fintech giant finally maturing into its prime. The expectation for SoFi has long been that it would eventually hit a ceiling, that the fintech fatigue would set in and crush the multiples back down to single digits, as we saw in the darker days of 2022 and 2023. The reality, however, is starkly different. We are looking at a company that has not only survived the high interest rate cycle, but has utilized it to build a fortress of deposits, now sitting with a market capitalization over $33 billion and a stock price that has nearly tripled from its lows. This divergence between what the skeptics predicted, a collapse of the neobank model, and what is actually happening on your screen right now is the exact reason why retail and institutional interest in this ticker is at fever pitch. When you look at the intraday chart today, the volume is already ticking up, with over 16 million shares changing hands in the first few hours of trading. This liquidity suggests that the big money is not sitting on the sidelines. We are seeing a rotation, a shift, where capital is moving from slow-growth legacy banking names into aggressive, technology-first platforms that have proven they can generate GAAP profitability. The price action today is choppy, yes, but it is forming a base. If you have been following Tesla stock over the last few years, you know that these periods of tight consolidation often precede violent moves. SoFi is currently displaying that same coiled spring energy. The market makers are testing the liquidity at these levels, trying to shake out the weak hands before the next leg of the journey begins. It is a classic setup where the expectation is a pullback, but the reality is a persistent bid that refuses to let the stock drop below the $26 support level. This resilience is what separates a speculative hype trade from a company that has fundamentally altered its earnings profile. The broader market context is critical here. We are in an environment where online investment and digital-first finance are no longer novelties, they are the standard. The days when you had to convince someone to invest online are gone. Now the battle is for dominance among the platforms that survived the purge. You have Robinhood stock trading volumes spiking as crypto creates headlines again. And you have the steady behemoths like Fidelity and Schwab Intelligent Portfolios trying to modernize their interfaces to keep up. But SoFi sits in a unique middle ground. It's not just a trading app like Robinhood. It's not a legacy dinosaur like the traditional banks. It's a comprehensive financial ecosystem. And that ecosystem is generating numbers that are forcing analysts to rewrite their models. Just weeks ago, on October 28, 2025, SoFi reported its Q3 2025 earnings, and the reaction was undeniable. Revenue hit $952 million, up nearly 38% year over year. But the metric that really matters, the one that destroys the bearish thesis, is the net income. They posted $139 million in GAAP net income. This is not adjusted EBITDA or some creative accounting metric designed to hide losses. This is real, hard cash profit, up 129% compared to the same time last year. This profitability is the reality that the market is still trying to digest. For years, the narrative was that fintechs could grow, but they could not make money. SoFi has shattered that expectation. They have proven that you can offer high-yield savings, command a massive lending book, and run a technology platform, all while expanding margins. This is why you see the stock holding firm at $27.48 today instead of drifting back to $15. The market is beginning to price SoFi not as a speculative bank, but as a compounding technology asset. When you compare this to the price action of Nvidia stock during its ascent, you see similarities in how the market reluctantly accepts a new valuation paradigm. At first, the PE seems high. SoFi is trading at roughly 50 times earnings, but as the earnings accelerate, that multiple compresses rapidly. The skeptics look at the PE and say, too expensive, but the growth investors look at the PEG ratio and the expansion of the financial services segment and see a bargain. Let's talk about that financial services segment because that's the engine driving this train. This includes SoFi Invest, the credit card business, and the checking and savings accounts. For a long time, this division was a loss leader. It was the marketing cost to get people in the door so they would take out a personal loan. Now, it's a profit center. The revenue from this segment has exploded, fueled by the relentless compounding of members. They now have 12.6 million members. Think about that scale. That is 12.6 million people who are waking up, checking their SoFi mobile app, and potentially engaging with multiple products. They might check their balance, buy a fractional share of Apple stock, and then apply for a credit card, all within seconds. This super app strategy was promised by many, but achieved by few. While PayPal and Block struggled to unify their offerings, SoFi quietly built a seamless integration that actually works. This stickiness is what scares the executives at Wells Fargo and Citi. It's not just about investment help or self-investing, it's about owning the entire financial life of a high-earning individual. Before we move further into the technical analysis and the future outlook, I want to hear from you. The debate on this stock is fierce, and everyone has a different entry price. Comment below how many shares of SoFi you currently hold, and more importantly, do you think Anthony Noto is the best CEO in the fintech space right now? I read every comment, and I want to know where the sentiment actually lies among real investors, not just the Wall Street analysts. Now, we must address the technology platform, specifically the Galileo and Technisys acquisition. This is the part of the business that is often misunderstood but is critical to the long-term thesis. If you think of Amazon as just a retailer, you miss the value of AWS. Similarly, if you think of SoFi as just a bank, you miss the value of its tech stack. SoFi owns the infrastructure that powers other fintechs. This is the B2B side of the house. In Q3 2025, this segment showed robust growth, but more importantly, it creates a moat. When a competitor wants to launch a new online investing product or a neobank feature, they often have to pay SoFi to do it. This diversification is what protects the stock when interest rates fluctuate. If lending slows down because rates are high, the tech platform continues to print money. It provides a hedge that pure-play lenders simply do not have. The competitive landscape is shifting rapidly. You have interactive brokers dominating the active trader market with their sophisticated tools and interactive brokers trading platform execution. You have Fidelity Investments leveraging their massive existing client base to cross-sell Fidelity mutual funds and Fidelity ETFs. Then you have SoFi Invest carving out a massive niche for the younger demographic who want simplicity but also want access to alternative assets. The recent relaunch of crypto trading on the SoFi platform is a direct shot across the bow at Robinhood Crypto. By integrating crypto alongside traditional banking and loans, SoFi is betting that users want a holistic view of their net worth, not fragmented accounts across 5 different apps. This expectation that crypto is dead was the narrative in 2023. The reality in late 2025 is that digital assets have become a standard part of a diversified portfolio, and SoFi is capitalizing on that resurgence without betting the entire farm on it like some other exchanges. Let's look at the risks, because no analysis is complete without a sober look at the downside. The stock is trading at $27.48, which is near a local high. The expectation is that the economy will achieve a soft landing or has already achieved it. But if we see a sudden spike in unemployment, the personal loan portfolio of SoFi could see default rates rise. While their borrowers have high FICO scores, typically averaging above 750, they are not immune to a recession. A downturn would test the credit model